This is Unit 7 out of a 10-part series for my personal finance money management classes. By the end of this unit, my hope is that students will be able to identify smart investing and retirement planning strategies to set themselves up for financial security in the future. We'll talk about the stock market. We'll break down a bunch of different definitions. We'll teach students how to identify what is happening with an individual investment using finance.yahoo.com or any other website for that matter that tracks the stock market. They will forecast how much money they could anticipate roughly in Social Security upon retirement, as well as how much money they could potentially earn and then grow into using the power of compound interest in a investment vehicle or retirement account such as a 401k, an IRA, a Roth IRA, or even a Roth 401k. The guided notes for this unit are hyperlinked here, as well as included if you are a teacher that is purchasing these units of study. So you can find these guided notes that students can interact with and work on while you are instructing and going through the lecture, so that it makes sure that it checks for their understanding and they can ask for their clarifying questions if necessary. Would you rather have $1 million to start with or a penny and double your money every single day for 30 days? This is an anticipatory set for students to start thinking about that power of compound interest, because if their money doubles every single day, starting with a penny, by the end of 30 days, they would have a much larger sum than that $1 million initial investment. And the next piece to get them thinking about that is the rule of 72, where we know what the interest rate is and the time or the term for the investment to double. This is kind of an eye-opener because it shows students how long they can expect for their money to double and grow over time. Every single year, I have students that come to my classroom with a variety of different starting points, and so I use this opportunity to get to know where my students are so that I can meet them where they are at. I have them in the Pear Deck again tell me anything that they know or have been told about the stock market and investing. The first question that we ask of the day is to think of and write down your 3 favorite large businesses and type them here in the Pear Deck, or write them out on the guided notes, or write them on a piece of paper. And I emphasize large businesses because these 3 businesses, hopefully if they're big enough, will be publicly traded on a stock exchange so that we can look up what their current value is right now and then use the tools of this unit to figure out how that investment is performing today, over the year, or over even its lifetime as well. We have to define a few different words or combinations of words so that students understand what is happening as we move through this unit. A diversified portfolio is a strategy where you mix a variety of different investments together so that it limits your risk by having multiple different investments instead of putting all your eggs in one basket. An investment vehicle is any kind of product that's used by investors to gain those positive returns. It could be, for example, real estate. It could be CDs. It could be a savings account. It could be in the stock market. It could be an index fund or a target date fund, all of which we will discuss throughout this unit. Risk and reward are directly related. The greater the risk, the greater the opportunity for a reward or loss. So it's worth getting that conversation started for your students. How risk tolerant are they? Are they somebody that likes to take great risk? Are they quite conservative with their money to the point where they have no interest in taking on any risk? If so, what type of investment opportunities might make the most sense for them? We watch a quick video on how the stock market works, how the stock market is operating, and how things are traded. Here's what we cover regarding the stock market. Bonds, very briefly, stocks or equities. We talk about the major indexes or indices, what an index fund is, a target date fund, mutual funds, IRAs and 401ks, Roth IRAs and Roth 401ks. The reason that I spend so little time talking about bonds is because it's usually one of the lowest risk investment vehicles, and typically a student that's taking this type of a class may be interested in this type of conservative investment, but at the same time is probably interested in exposure to a little bit more reward in relation to having a little bit more risk as well. The bond is very low risk because, well, frankly, it's you lending money somewhere for somebody to use, and as a result, this entity that's borrowing your money, usually it's going to be like a government or corporation of sorts, is giving you a steady stream of income, and in a return, usually speaking, not always, somebody that is a more conservative investor will put their money in bonds. For example, my mom, as she ages, is going to be putting more of her money towards bonds, which are less risky, instead of putting her money into equities or stocks or individual investments, because those have greater volatility. They have greater upswings and downswings, and she's looking for stability and long-term prosperity to be able to maintain her wealth instead of for taking on that risk, which she doesn't necessarily need that exposure for. Let's define what a stock is. It's the ownership of a fraction of a corporation. So if I say that I own a share of Costco, guess what? I'm a Costco owner. I own Costco. I own a small share, a very small share of Costco as a fractional owner of that. This entitles me as the owner of that stock to a proportion of the corporation's assets and profits equal to how many individual shares of ownership I have. So a unit of stock is called a share. It is one of the most risky investments because if I have all my money in one particular stock and that stock goes down, I'm in trouble. However, on the flip side, if you have some kind of information or understand an investment that is going to be having a major upswing, if you put all your eggs in that basket, that risk and reward is going to work in your favor. But unfortunately, it doesn't always work that way. So let's break down how you can read the basics of what you can see on just about any kind of website that tracks the stock market. The first thing we need to know is what the ticker symbol is. The ticker symbol is just a quick abbreviation for the business that you're looking up and how it's performing. For example, with Costco, I'm a super Costco fan. In fact, you probably can't see it, but that puzzle above the lamp right there behind my head is actually of Costco. There's no way Costco will ever see this video, but if they do, I'm a super fan. Anyways, enough of that random message here. But Costco's ticker symbol is COST. And this is just an abbreviation that allows you to find your investment to look up how it's performing. The current price, that's exactly how it sounds. It's the current price. If I wanted to buy one share of ownership of Costco, it would be $925.63. And that is today as of October 1st, 2025. By the time you watch this, that price will likely be significantly different. Hopefully it's on the upswing because, again, I do own shares of Costco. The opening price, that just means when the stock market opened today, what was its opening price? And in this case, it was $916.59. If I was to have purchased a price at the very, very beginning of the day, that's pretty close to where I would have found it. The days range, this just means what is the lowest that the stock is traded at for its current price in the day, or what's its highest price that it has traded at for its current price at the day. And so this is just the range at which that investment has moved throughout your day. The bid and the ask. So this is the highest price that a buyer is currently willing to pay for a stock, while the ask is the lowest price a seller is willing to accept. The volume just tells you how many transactions have taken place throughout the day. And so you can also see it so you see the graph and how it's moving up and down. But if you look below, there's those vertical lines that are going up and down. That also shows you the volume of transactions that are taking place at any given time. So if you have a big volume day, that means that there's likely some news that has happened as a result of many transactions happening. So for example, if Costco came out and offered a special dividend, which we'll talk about in a moment, there might be an uproar of people saying, I want to buy a bunch of Costco stock to be able to take part in this extra dividend reward that will come my way. And so you'll see the volume spike up. Or maybe there's some bad news that comes out, like I hope it doesn't happen, but some kind of listeria outbreak and some food is contaminated and people get really sick. And then there's a lawsuit that comes about. And then you see the volume still goes up, but you see the dollar value start to come down. So the general idea with the volume is the number of transactions that are taking place. It's also worth noting directly below that you can see the average volume. And what that means is that that's the average volume on any given day that Costco trades at. So today, for example, you can see there's 3 million transactions that have taken place, whether it's a purchase or a sale of the investment of Costco, but the average volume is about $2.2 million on any given day. So that means there's a little bit more movement today than on a traditional day. The market capitalization is just the total value of how much that company is ultimately worth. So it's the value of companies' outstanding shares calculated by multiplying the current stock price by the total number of shares that are issued. The PE ratio, the price to earnings ratio, is a quick metric that you can use when you're just briefly skimming through these things. If you're looking for some kind of a deal or investment, if you're comparing, Costco versus Sam's Club, which is actually owned by Walmart, so that's kind of a bad representation. But let's say like Home Depot versus Lowe's, I could use the price to earnings ratio to show that company's stock price relative to its earnings per share. And I can see, is this a good investment as of right this moment or potentially not? And there are so many other factors to consider before actually just using price to earnings ratios as your determining factor to make a purchase, but it is a good starting point. We can also look at when these companies need to report their earnings, because as a publicly traded company, meaning that they are not private, they are not a business that doesn't have to report their earnings. As a shareholder of Costco needs to report to me to tell me, hey, here's what's happening with our sales. Here's what's going well with certain metrics of the business. And because of that, they tell us when their earnings dates are going to be, so I can watch when they unveil how they've been performing over a certain amount of time, a specific period. Usually it's going to be quarterly, but it could also be an annual earnings date as well. And it's also worth noting that some businesses will offer a dividend. A dividend just means that they are going to give you a small portion of proceeds that they have been earning in the form of profits that they want to entice their investors with, to say, hey, thanks for being a loyal investor of our business. We would like to honor you and award you with this small, sometimes not small, fraction of the share value because you're an investor of ours. If you own a bunch of investments of that business, guess what? You receive more dividends. And so they also tell you the exact date at which it is that you need to hold the investment for so that you can receive that dividend. So the dividend shows how much a company is going to pay out. And in this case, you can see that not the greatest, but Costco is paying about just a little bit over 0.5% of their dollar value. So 5.2, so $5.20 for every one share that you own, which is currently at $925. You could see dividends get much higher than this. You could also see companies that offer no dividend. The general idea is that I need to own that share of stock by that X dividend date in order for me to receive that upcoming dividend yield payment. There are absolutely investment strategies that revolve around dividends payments, and it could be a lucrative strategy for somebody that is just looking to buy and hold and not necessarily liquidate and sell their investments and have to pay those capital gains taxes. Definitely an opportunity. Do note that those dividends are subject to taxes, which we'll talk about next unit. And then the 1-year target estimate is just a stock price forecast. This is usually going to be made by financial experts and analysts and suggest the price will reach this particular price point within the next 12 months. Going back to those 3 companies you identified earlier, now that you know a little bit more about how to read about that general stock, now you can take a few minutes to look up your 3 ticker symbols. Do note that if your company is big but privately traded, for example, like IKEA or Lego, those are privately traded, and as a result, you will not find them. But if you were to enter the name of the business, you'll likely find the ticker symbol, and then you can go over to that website, which I use finance.yahoo.com only because I've been doing it for 20 years with that website, maybe even longer. There's a million of them out there. I also use fidelity.com as a brokerage, so I can use that information as well. Anywho, regardless, at this time, now you would want to go look up that business name, find its ticker symbol, and see how is it performing using the information we just went through. Now, if you're somebody that doesn't necessarily want to go and just pick stocks, because that is risky if you don't know what you're looking for, how do you know if you're buying low? How do you know if you're buying high? There is an opportunity for you to hire specific financial advisors, and we'll talk about that shortly. But if you're somebody that does not want to do that, and you would instead rather like to just have broad exposure to a diversified investment vehicle, well, what you can do is you can purchase into what's called an index. An index is, just for lack of better words, it's just a collection of investments. It's you take a bunch of different investments, usually equities, and we'll pile them all together. So for example, I could buy Facebook, Apple, Netflix, Google, Nvidia, all of these technology specific types of equities or stocks, and I could, instead of buying them individually, I can buy them as a whole. And the hope with this is to diversify, to spread out my risk by, if one of them goes up, that's great news. But if one of them goes down, hopefully the one that went up counterbalances it so that I've limited my risk and still reap that reward. And so these index funds are a collection of investments Again, usually stocks that represent a specific market or a segment of the market. They are used to track performance of a particular asset class or market sector, and they serve as a benchmark to measure how a group of assets is doing over time. So why would somebody want to invest in one of these indexes instead of an individual stock? And the answer is just diversification. And so you can invest specifically in a index that tracks just about the entire market, or you could pick just the what are called blue chip investments of the United States, or you could track just technology. And so if we wanted to talk about an index that tracks the 500 leading companies on the stock exchange in the United States, we would look at the S&P 500, and there are index funds, which we'll talk about in just a second, that you can do that with. For example, this is not a financial advice or recommendation, but you could buy a ticker symbol, for example, something called VOO. And if you were to look that up, it's a Vanguard index fund that tracks the S&P 500. If I wanted to go and just track straight up technology, which has been ripping for the past year and a half, for a variety of reasons, which I'm not going to get into right now, I could track the NASDAQ, which is another index that is US-based stock exchange. It's a popular index because of the notable technology heaviness that it carries. And so if I wanted to track the NASDAQ, I could use something like QQQ, which is an index fund. I am not advising you to do that. I'm just telling you that these are ways that you can purchase the total technology sector instead of individual stocks, so you can diversify your risk. So QQQ, QQQM as well would also be different opportunities. And then the Dow Jones Industrial Average tracks the 30 prominent companies called blue chip investments. These are businesses that are supposed to be pretty tried and true United States domestic businesses that are usually going to be older and most commonly followed by equity indexes. So an index fund is just a portfolio of stocks that are designed to match or track the components of a financial index. Now, it does not have to just be the S&P 500, NASDAQ, Dow Jones. It could also, you could track straight up businesses that are following like real estate. You could do investments that are tracking energy or healthcare or utilities, fill in the blank. There are so many different types of index funds that offer broad market exposure, and they generally, here's the key, here's the big benefit, is that they oftentimes offer generally low operating costs. They are what are called passively managed, meaning that they are typically just mirroring an existing index, and they require less management and research, which results in lower fees. For example, if I was to go and hire somebody to do my investing for me, I have to pay that person a fee. And I'm not saying that's bad. I'm just saying that that is an extra fee that's coming out of my potential rewards that I would earn otherwise. And so these index funds track a sector or index, and it just performs the way that that sector or index is performing, which can be very lucrative for you with very low fees. It's called passively managed because there's not an active manager overseeing it. And if there is an active manager, it is very slim, and that they are just shuffling what that index is tracking to mirror whatever the index is that you're following. These are the 30 companies that make up the Dow Jones, or at least they were as of last year. Some may have shifted, and they do change as the valuations change. But this just gives you an idea as to the exposure. If you were to track just the Dow Jones Industrial Average, these 30 blue chip companies are going to mirror, and you can see that you have exposure to technology, healthcare, consumer goods and retail, financial services, industrial manufacturing. And so that's why you can see why there is some diversification. If technology starts to falter, hopefully you would have something else to bring it up, like consumer goods and retail or financial services. Now that you've got your 3 identified ticker symbols and you've looked those up, now the hope would be that you could see how would you have performed for this given day. So if you find your combined return for today, what you would do is you would take the percentages gained or lost for each of your 3 investments. And we would assume that you're putting in the exact same amount of money for each one, even though that's unrealistic. You would add those 3 percentages together, divide by 3 to find your average percentage change. And then what we could also do with that is look at what is the average up and down from that. Not going to get into that too much, the average rate of return. But for right now, what we want to know is what is your combined rate of return just for today, so that you could see how you have performed if you were to have purchased it. And you could see in this example right here, if I own Costco, maybe I'm up 2.65% today. Cool. But if I owned only Apple, I'm down 5.46%. If all my eggs were in that basket, I'm not that excited. But if I own Netflix also in an equal proportionate amount, I'm now up 5.22%. When I average those out, the total average for my day would be 2.44% 2.41% upwards instead of 5.46 downwards from owning just Apple. I've now taken that average to reduce my risk to have exposure across multiple investments, which gets us to the conversation of a different type of diversified investment vehicle, and this is what's called a mutual fund. There's a lot of similarity between this and an index fund in that it is not just one individual equity, it's multiple investments that are put together and pieced together, but it is actively managed, meaning there is a financial advisor or management team that are putting together not just your money, but a pool of money collected from many investors to invest in different securities like stocks and bonds and money market instruments and other assets. And these mutual funds are operated by a professional money manager. When you hear professional money manager, that's associated with a fee. That fee is going to potentially eat away at your earnings. But the idea is that these professional money managers will outperform the market or other indices, which are common. And so you're paying for the expertise of somebody to hopefully outperform the market or at least match the market so that you don't have to really think about what's going on and that you just trust this person to make the decisions on your behalf. When I say actively managed, I just mean that there is a manager or team that actively conducts research to make investment decisions for you. If you are the person out there that is like, I don't want to track an index, I don't want to pay somebody either to actively manage my investments, there is another alternative option where you can still find diversification and still have some type of rebalancing so that as time changes, you can also change with it. And that is called a target date fund. And I'm a huge fan of this specifically for the person that wants to be hands off, that does not want to just go out and pick individual stocks, but instead they want to set it and forget it and be very hands off with low fee structures. And the target date fund generally works like this. Pick a date at which you expect to retire. So for example, if I'm 41 years old and I plan to retire, let's use 62 when I'm eligible for Social Security, because we'll talk about that soon. So knowing that those are the values, I would have 21 years from now. If it's 2025, that would take me to 2046 for retirement. Now that I know what year I want to retire, now I have to check what type of risk exposure I'm willing to have. Am I conservative? Am I moderate? Am I moderate aggressive? Or am I aggressive? Or other types of risk profiles. Now that I know what risk profile I'm falling within, I can take that same information. I would get a target date fund, probably realistically in increments of 5. I would get a target date fund for 2045. For me, probably moderately aggressive. And then it would reallocate the investments every single time when the winds are changing within the stock market so that my portfolio shifts as the market starts to adapt. And so the target date fund often offers a very low-ish fee structure, which can be quite advantageous to many people. You can find target date funds in many of your 401k offerings. Imagine all of those things we just discussed. And now you've set aside enough money. You don't have to work or go to school anymore, and you have no obligation starting tomorrow. What would you do to pass that time? I could tell you exactly what I would do, and nobody's asking. But for me, I would start every single day with some kind of decent breakfast. I would probably go to the gym. After the gym, I'd eat some kind of brunch and then head off over to the golf course and play 9 or 18 holes, come home, maybe take a nap, and then start working on a early supper, because it's probably going to take me some time because I want to spend some time making it. And maybe I would prune some flowers and spend some time doing a little bit more around my house. All of these ideas right here is the general concept of retirement. I would also want to be able to go and travel and spoil my grandkids and my kids and do fun things with them. The idea of retirement is leaving your career and ceasing to work. Once you've reached retirement age as early as 62 years old, you will be eligible for Social Security as long as you paid into it. Most people do pay into Social Security, and as such, your employer will actually take out 6.2% of your income to go towards Social Security of the people that are actually the recipients of Social Security right now. So fun fact, many people think that they are paying into Social Security into some type of account that will eventually go to them, but that's just not the case. That's not how it works. Instead, the Social Security that you pay today is paying for the Social Security benefits of the people that are retired as of right now. Now, it's a kind of fun activity, or at least in my opinion, or eye-opening, maybe not fun, for students to see how much they can estimate their Social Security will be. I provide you with a link up there in the top area to estimate how much you will earn per month in Social Security upon retirement. It's worth noting that that website, which is a legitimate website, it's socialsecurity.gov, does require you to enter your date of birth. It will not calculate your estimate unless you are at least 21 years old. So if you are under 21 years old, you'll need to adjust your date of birth to meet that criteria. And you are eligible for Social Security, like I said before, as early as 62 years old. But if you postpone it and start receiving those Social Security benefits at a later date, you will actually receive a greater benefit per month. And so once you click on that Social Security link, you'll figure out what your monthly benefit will be. And then we will quickly identify that that monthly benefit is significantly less than what your gross monthly income would be of the career that you're pursuing. If you're in my class, and we're following an entire career for the whole semester. If you're not in this class and you're viewing it in a different way, I still would recommend that you pick a career, identify the monthly income, and then compare it to what your Social Security payout will be. Even with inflated dollars, it is highly likely that it will be significantly less than that which you're earning right now. And that's the reason why we have to be putting aside money into a different type of an account, which is that 401k. And in fact, I show you this video. When you click on that image of that fake Social Security card, it'll show you how much, or that video describes a person saying that you can't live on Social Security alone. So we want to supplement our retirement income each month with some type of other type of source of income. And there's many different types of investments that we could go through. We could talk about, maybe at some point or another, you would purchase some rental properties, and those rental properties are generating income every single month passively, which is amazing for you. That passive income right there is going to supplement that Social Security. Or perhaps maybe you have significant stock investments that are providing with dividend income every single month. That's another great pathway. Maybe you have a small business or a big business where you're receiving royalties, or maybe you are still receiving income from it. Maybe you're still working. Maybe you have a side hustle as some type of a part-time job. So I also own and operate a business, a home repair business, handyman business, and that provides me with supplemental income as well. And maybe I'll do that in retirement, but maybe I won't. But the big key item is this: Social Security alone, assuming it exists, because there are also conversations of will it actually be able to fund itself until retirement age for everybody that is now currently paying into it. And I don't know that answer. That's something to keep your eye on with economics. But bottom line is you need to be making sure that you have more money set aside so that when you go to retire, you don't have to rely on Social Security alone, because it would be a really big financial shock to you to go from your regular gross monthly income or net monthly income down to what you would receive in Social Security. And that's why we talk about putting your money inside of some type of a retirement account as early as possible. As early as you start working is when you are eligible to begin contributing to these retirement accounts. And the first one we'll talk about is called a 401k. And so this is an employer-sponsored individual retirement account. You can't go and get a 401k account unless you have an employer that offers one. However, you could potentially open up what's called an individual retirement account, an IRA. It does the same thing as the 401k. The big idea is this: you don't pay taxes on the dollars right now. However, as the account grows, because it's a type of an account, just like a checking account or a savings account, and then once you put that money inside of that savings account, the money is going to then be invested into whether it's an index fund or a target date fund or individual equities, depending on who your brokerage is, where you have your 401k. That money is then hopefully over years and years and years going to grow and compound, and maybe dividends get pushed back into that money, and it continues to grow. Once you start taking those distributions out, those distributions are taxed at that time. And so you can take money out of your 401k account as early as 59 and a half years old. And it's also worth noting there are some employers that will match your contributions up to a certain percentage. So for example, let's say that I put in 3%, my employer might put in 3%. And if that's the maximum that they'll match me at, then I would stop at 3%, max that out, and I get a free 3% raise that's going into that account that grows and compounds for years and years to come. If I'm 18 years old and I go to retire at 62, that's 44 years that the money has to earn on itself and continue to compound with economic growth. And so I give you this tool, and I call this in my assignments the Power of Compound Interest tool, 401k estimation. This tool, it's linked right there as well as in the guided notes for this unit, allows you to take your gross monthly income I have my students use 3% of their gross monthly income for their 401k contribution, plus another 3% of a match coming from their employer. So a total of 6% of their gross monthly income. And so for easy numbers here, let's say that my gross monthly income is $10,000. And so if I make $10,000 every single month and 6% of it is going into the 401k account, I know that $600 every single month will go into it. I use that link, which is just a compound interest calculator. I enter my 6% total, which is my 3 plus my employer's 3. And then I enter additional information. I say that I start with a zero in initial investment because I haven't put any money in it yet. I say that my monthly contribution is 6% of my gross monthly income going into this 401k. I reference my Unit 1 payroll deduction packet for my fictitious career if you're a student that's in my classes. And then I put the length of time being at a minimum. I'm going to say 62, even though you technically could go at 59 and a half. Let's say 62 minus your current age. As such, let's say that they have 40 years for their money to compound. So I would put in 40 years as the length of time. The estimated interest rate, I would recommend that you go to Google and or whatever search engine you use and research the stock market historical rate of return. Right now, when I'm filming this in 2025, it is hovering close to 11%, which is wild. To be on the more conservative side, I usually have students put in about 6%, 7%, maybe even 8%. And then from there, we use that number, and that'll be the frequency in which we compound, which is annually. And so every single year, your account compounds, just like as we discussed earlier with that money doubling every single month or every single day with that penny example. In this instance, your money isn't necessarily doubling, but it's growing. One, because the stock or individual equity is going up in price. Two, if that investment has dividends, that dividend then goes back into the account, which is now more. Three, if you have some type of like a bond or something, it comes to its maturity date and then that money comes back due to you with the interest that was owed to you. All of this continues to grow and grow and grow. And then it gives you an estimation as to how much money you will have in approximation upon retirement. Do know this is an estimate only. There's no way that you could possibly get it. There's so many variables that change with this. Variables, for example, right? This is going to assume that your money stops compounding upon retirement, but this is the next step. So the first step in order for me to estimate my retirement income is to multiply my expected number of years in retirement. So if I'm, let's say, retiring at 62 years old, and then I, hopefully live a longer life than this, but let's say I pass away at 85 years old, that's another 23 years that I need to be able to live on my financial decisions. So I take my 23 years times 12 months in a year, and the number that is going to give me is the number of months that my money needs to last me. So now that I have that number, I need to then take my 3% of my income of my contribution plus my employer's contribution of 3%, giving me the 6% total monthly contribution. I put it in that compound interest calculator. I estimate my total balance at retirement of 62 years old. I take that number and I'm going to divide it by the total number of months that I got from step one, because that's how many months I expect to live in retirement. Now that I have that number, that tells me how much money per month from my 401k savings I will now have in addition to my Social Security, which is step 3, where I take my monthly Social Security forecast of step 3, and that money is then going to be added to the amount of money that I have per month from my 401k contributions. Do note that, again, those 401k contributions, now that I'm taking them as distributions, are taxable. I then take that number as my Social Security plus my 401k monthly income, and I can compare that to my net monthly income from my Unit 1 payroll deduction packet, or if you're not from my class, just how much money it is that you expect to be making upon retirement before you retire in your last years as your career, to see, can you live off of that amount of money? And most cases, students are going to find that yes, they can. Do note, like I said before, this calculation is a simplified estimate. It assumes you stop compounding once you retire and that you fully liquidate your account, which is just highly unlikely. That is not how retirement income typically works, but it gives you an idea. The other type of account that I want to talk about, so I did share that a 401k is employer sponsored. An IRA works just like a 401k, but the big difference is the 401k has to come from your employer. The IRA does not need to be tied to your employer. It's worth noting, if you have a 401k and you leave your employer, you must roll it over into a traditional IRA so that it comes with you and does not get taxed and penalized by the government by taking the money out before retirement as early as 59 and a half years old. The other type of account that we can talk about, so remembering the IRA and 401k, you don't pay taxes on now. You pay taxes on it once you start taking distributions in retirement. The Roth IRA or Roth 401k, if your employer offers one, is a different type of an account structure. And what that does is it allows you to pay taxes on the money now when you're putting money into it, and then it grows tax free. So if you put money in at 18 years old and you had a job and you're putting that money in, now it grows because you paid taxes on it now, completely tax free for the next 44 years. And now when you take that money out, you pay zero taxes on it because you already paid taxes on it 44 years ago. And every single month, if you continue to put money in it, that thing becomes a tax advantaged absolute powerhouse. There's many reasons why you would consider a Roth IRA. There's many reasons why you would consider an IRA. It really just depends on your circumstances and whatnot. But they are very, very powerful tools. Do remember, once you put your money in that 401k, that IRA, that Roth IRA, or that Roth 401k, you still have to tell it what to do. Do you invest in a target date fund, an index fund, individual equities? It's really up to you and what your employer, if it's through an employer-sponsored program, offers. And it's the tipping point for what determines what your retirement picture looks like. So do make sure that you understand this content because it's so critical to make sure you live your best life and live out the retirement that you envision to make sure that you are living in prosperity in the way that you hope to reach. With that, I have students finally finish by writing a question, thought, comment, or request for clarification. I do this in the Pear Deck because I have a bunch of students that may not raise their hand if I was just to ask this out to the class, but in the Pear Deck, they'll type it. Everybody types something. And then even that quiet student or introverted student or student that just doesn't feel comfortable talking in front of the class will then participate and still have the opportunity to have their voice heard. Once again, my name is Mr. Feldman. I'm with the Business Teacher Toolkit, and this was Basics of Investments and Retirement Planning. Hopefully, at this time, you and your students or my students can start investing and retirement planning to set themselves up for financial security in